price areas because we do not want to be buying at a point where the stock may be going down. We want to be buying at a point where the stock is likely to go up. Support and resistance is what we use to determine the potential of risk to our reward, and therefore help assist us in making buy and sell decisions. You want to be always buying at support to reduce as much risk as possible and sell near resistance to gain as much reward as possible. We identify these levels by pulling up a stock chart and looking at past price performance. I'll show you how in a few minutes, but let's get a better understanding of what exactly support and resistance is. Here we have a 6-floor building, and if we were on the first floor, the floor would be our support and the ceiling would be resistance. Let's say that whoever designed this building forgot to put in an elevator or stairs. And if we wanted to go up to the second floor, we would need to take out a sledgehammer and then bust a hole through the ceiling and crawl up the hole, and then that will get us to the second floor. It would take a little work, but we could do it if we really wanted to. Once we bust through and climb through the second floor, which was once the ceiling, will now become the floor. As you can see, support and resistance interchange with each other once you move up or down floors, which was once resistance, now becomes support. If we wanted to go back down to the first floor, which was once support, will now become resistance again. Price tends to pinball in between support and resistance, attempting to go up floors or down floors. It's at these levels where we see the most buying and selling, and depending on who is stronger, the buyers or the sellers, they will determine if we are going to go up floors or down floors. If price was rising to the ceiling, if there are more buyers than sellers, then we will break through and go up to the second floor. If this building had a basement and price was falling down to the floor, if there are more sellers than buyers, then we would break down through the floor and be in the basement. To identify support and resistance when trading stocks, we need to determine the floors and the ceilings located on a particular stock's chart. To do this, we need to identify all the swing highs and the swing lows. A swing high is where the price rises up and then curves back down. A swing low is where the price goes down and then curves back up. Now, this does take a little bit of practice to see, but we can identify these swing highs and swing lows by drawing upside down U's and upright U's. So we'll start with the swing highs first. We are going to draw upside down U's on the tops of the candles, which would look like this. Now that we have identified all the upside down U's, we need to draw horizontal lines across all the tops of the upside down U's. This is going to give us all the possible resistance areas the stock could run into in the near term future. So now that we have the swing highs, we need to identify the swing lows. Again, a swing low is where the price falls down and then curves back up. So we need to identify these by drawing upright U's. Once we have that, we need to draw our horizontal lines on the bottoms of the upright U's. And once we have that, we get a chart that looks like this. Now we have the framework of possible areas this stock may have trouble going either up or down. Remember, stocks tend to pinball in between these levels, testing new floors and ceilings. So let's look at how this stock plays out for the rest of the day. Notice how the future price action respects every level that we have mapped out beforehand based off the past price action. This is the area we used out to map out all these levels. And as you see, for the rest of the day, the stock tests them in some way or another. Now, we can't predict which way the stock will go. This stock could have fallen all day long at this point right here. But at least that we've mapped out possible areas where the stock could get held up at. Looking at this chart, where could you identify support? To identify support, we need to identify the swing lows. So I see 3 of them that look like they can fall right in the same area. So if I were to place a straight horizontal line across all the bottoms of the swing lows, I will get something that looks like this. So it looks like that at $4.39 is the common level where this stock has trouble going down. Notice this stock has tested it 3 different times and it can still not go below $4.39. Now, I get a common question about where exactly should you be placing your lines. Do you place them at the bottom of the candle bodies, or do you try to touch them on the bottom of the candle wicks? Which way is best? Well, it doesn't matter as long as you're not going through the candle bodies themselves. The goal is to try to get as many touches as possible. So here's a touch at the candle body, here's a touch at the candle wick, here's a touch at the candle bodies. It's okay to go through the wicks, but typically you don't want to go through the candle bodies. You also don't need to be overly concerned about getting this to the exact penny because these lines are more like zones. You want to just keep this area on watch because not all the time a stock's going to come right to the exact penny and then bounce off of. You kind of want to keep just a close eye. So if this stock were to come into maybe $4.50, that's the area where I would start to pay attention to. Here's an example of a resistance line at $2.60, being tested and respected 3 times, but still not breaking. I can keep this level on watch so that if in the future we start coming into a price, maybe around $2.40, I'll set an alarm at $2.40, I would now start to take notice and pay more attention to see how buyers and sellers react around $2.60. Notice on the far left box, we don't get a picture-perfect swing high. We get a single candle that reaches near 260, but then gets sold off. Even though it's not a swing high, it's still a valid confirmation that $2.60 is a resistance level. Here we have an example of support changing to resistance. You see how we get a swing low in the green box with the bottom respecting 708 as a support level. We get the bounce off of 708, eventually come back down to test 708, but then sellers outnumber the buyers and are able to push the stock below 708. We get an attempt to come back up to test 708, but this time as resistance. We fail 3 times to get back above 708, and since this has been tested as support and resistance, 708 is going to be a level to pay close attention to. Now, support and resistance isn't always drawn in picture-perfect horizontal lines. They can also be drawn as diagonal lines. Notice how the bottoms of the swing lows are increasing as price action continues. This forms when a stock is uptrending. We can draw a straight diagonal line hitting the bottoms of the swing lows, forming what is called an ascending support trend line. Here is a downtrending stock. Resistance can be drawn on the top of the swing highs, forming a descending resistance trend line. When mapping out support and resistance, it is always important to start with the daily chart first, because stocks tend to trade in the context of its daily chart. Support and resistance levels on the daily chart will always be stronger than support and resistance on faster time frames, such as the 1 minute or the 5 minute chart. We only use the 1 minute and 5 minute charts to see in more detail what the price action is doing around these daily support and resistance levels so that we can determine how we are going to trade the stock. By taking trades based off daily support and resistance, we can obtain a higher probability for success. This is the chart we previously used to draw all of our swing highs and swing lows, and this was done on a 1 minute chart. And as you can see, it can look very cluttered. Trying to trade off support and resistance levels that are very close together like this can be extremely difficult because profit targets are going to be smaller. You're most likely going to get stopped out or faked out many times. Not to mention, you may be tempted to overtrade or start averaging into losing positions, which are very bad trading habits. Remember, support and resistance levels on a fast time frame are not as strong as daily support and resistance, and therefore it's harder to predict what the price is going to do around these levels. So by only trading around daily support and resistance levels, we can force ourselves to only trade the best setups, providing us with big profit targets while also keeping our risk very small. It will also force us to stay patient and keep us from overtrading. All right, so let's say that before the market opens, we come to our trading computer, we log in, we see which stocks are trading on abnormally high volume pre-market, and UXIN is one of those stocks. We pull up its daily chart and map out all the support and resistance levels based off previous swing highs and swing lows located in the colored boxes. We notice that UXIN is about to come close to a resistance level of 708. We get this resistance level by the interchanging support and resistance based off the red boxes. So we get the support right here, it drops down, we get resistance, resistance, resistance. So 708 is going to be a level to watch out for. Once we come into 708, are we going to reject off of 708 and come back down again, or are we going to break through it and then come up to test 791? 791 is a level based off of a mini swing high off of this blue boxed area right here. If we break above 791, are we going to come up and test the next resistance at 877, which is based off of this swing high in this green box? This is what we need to be thinking about before entering the trade, kind of planning what the stock could do around these levels so that we can take a trade. On the right side is the daily chart showing the daily candle of what actually happens on that day. So we see that this candle, we do break through 708 resistance. We break through 791 resistance. We come up to test 877 as resistance, but as you see, we sell off because we get a long wick right here. So if we wanted to see what actually happened to price action inside this daily candle, we need to go into a faster time frame, such as the 1 minute chart, which is located over here on the left. Notice how we respect each and every single one of these levels. These yellow lines right here are just a representation of the resistance levels on the daily chart. They're the same lines. So notice that almost to the T, we respect these levels. We find some support at 708. You find some resistance at 791. We get a little bit of support at 791. These levels are very well respected. So let's take a look at the morning trading. If we were looking at the stock pre-market, what would have happened? Well, we see the stock eventually come up to that 708 level. We look for the break of 708. We see it breaks, and then eventually it comes up to test the next resistance level at 791. We get rejected off of 791. It falls for a couple hours before breaking 791, and then we go up to the next resistance level at 877. We fall from 877, but then go back up to test 877, try to break through, but can't hold, and then we sell off for the rest of the day, eventually finding 708 as support. If we were to buy at the breaks of either 708 or 709, we could place a tight stop just underneath these levels for a target for the next resistance. So if we bought at 708 for the break, we can place a stop just underneath this level and have a target of 791. So maybe if we sold right here, we notice the stock start to sell off, and then we say, okay, well, it's coming back up to resistance again. Let's see if it breaks. Once it breaks, we can buy and then place a tight stop just underneath 791 with a profit target of 877, and this is where we would sell. So as you can see, your risk to reward ratios are very large if you just play these daily resistance levels. Let's zoom in on the 1 minute chart to look at the price action in more detail. You never want to buy a stock as soon as resistance breaks because oftentimes it will be a false breakout and the price will likely fall from that level. By doing so, you have to remember that you are buying at resistance, which is not where you want to be buying. You want to be buying at support. So we need to wait for resistance to turn into support before we buy. Notice inside the red box, we get the break of 708 as resistance, but then we start to form a mini swing low to test 708 as support. Since this level holds as support and we make new highs afterwards, that means 708 is a support level, and thus we get buyers to come and step in and push this stock all the way up to the next resistance level at 791. Now inside the blue box on the left, notice how it barely breaks 791. If we were to buy as soon as it broke 791, this would be a false breakout and we would find ourselves in a losing trade. This stock ends up dropping for the next 2 hours before eventually coming back up to 791 to test it as resistance again, but this time we actually break through. Soon after the breakthrough, we get another swing low. This is a very, very tiny swing low right here. It's actually called a bull flag. We'll go over that in another lesson, but This is the confirmation that 791 is going to be the level of support. So it's holding this level, and once we get the break of the new high, then we are on our way to test up to the next resistance level at 877. So we come up to test 877, we get rejected, we come back up to test 877 again. We get the break of 877, but look what happens. We don't hold. We get the break, it's a false breakout, and then from there, we fall all day long. So you can see that only trading around support and resistance levels on the daily chart can be more predictable, more rewarding, less risky, and less complicated as opposed to this. It's important to take note of gaps on a daily chart because these can present very easy and predictable opportunities. Gaps occur when a stock releases news that causes the stock to open much higher or lower than the previous day's close. What happens is that once the price reaches inside the gap, price will rise up to fill the gap. The top and the bottom of the gap will be the support and resistance. If price reaches inside the gap, there's not going to be any resistance until the top of the gap, which is why gap fills occur rather quickly. Inside the green box on the left is where the gap occurs. On this particular day, the stock came out with some really bad news that has caused the stock to open much lower than the previous day close, thus creating the gap. Now, gap fills can take weeks, months, or years to complete, but eventually you see the stock come back up to start to test the gap. Now, the bottom of the gap is going to be resistance. So once we break through resistance, we come up to get the gap fill, and it only takes a few days to actually fill the gap, and then we test the next resistance level, which is actually the top of the gap. Whole and half dollars can act as support and resistance because those numbers are easy for us to work with. Think $5, $3, or $6.50 and $2.50. It's easy to determine risk versus reward with numbers you can easily do in your head. Buying at $5 with a stop at $4.90 and a target of $5.50 is a little easier to think about instead of buying at $5.23 with a stop of $5.13 and a stop of $73. This is why it's common to see support and resistance levels on the chart form around whole dollars and half dollars. It's because the majority of traders think in whole and half dollars. So pay special attention when you find major support and resistance levels fall near whole and half dollars because these can provide really strong setups. Notice that the interchanging support and resistance line I've drawn is at $7.08. Since this is so close to a whole dollar number of $7, I will base my trade off of $7, not $7.08. The only indicator I use other than volume are moving averages because they can act as support and resistance as well. Moving averages calculate the average price over a defined time period. If I wanted to see a stock's 20 moving average on the 1 minute chart, it will calculate the average price over the last 20 1-minute candles. If I wanted to see a stock's 20 moving average on the 5 minute chart, it will calculate the average price over the last 20 5-minute candles. So the moving averages on one time frame would be completely different than moving averages on another time frame. A stock trading above its moving averages is uptrending, while a stock trading below its moving averages is downtrending. So you'll find that stock prices tend to ride common moving averages or even bounce off of them, causing moving averages to act as support or resistance on both intraday and daily time frames. Price action on intraday charts such as the 1 minute and the 5 minute can be really volatile, so we need to be using moving averages that can keep up with the fast price action, which is why we use exponential moving averages on these time frames. An exponential moving average takes the average price of whatever time period you set it for, but it puts more emphasis on the most recent price action, thus causing it to react more to faster fluctuations. The most common exponential moving averages on the 1 minute and 5 minute chart are the 9 and the 20. Now on the daily chart, we should be using regular moving averages because these are slower time frames. The most common moving averages on the daily chart are the 50-day, the 100-day, and the 200-day. Here we have a 1 minute chart showing the price action relating to its 9 and 20 EMAs, also known as exponential moving averages. The red line is the 9 EMA, and the green line is the 20 EMA. Notice how this stock rides the 9 EMA, bouncing off of it, holding the price up as support. But once it falls below the 9 EMA, it finds support at the 20. Since this stock is trading above its moving averages, it trends higher. But once it falls below the moving averages, it starts to trend lower. Here is a daily chart showing the major moving averages such as the 50, the 100, and the 200. Notice how this stock reacts to its moving averages as either support or resistance. Not only do you need to map out daily support and resistance levels according to the swing highs and the swing lows, you also have to map out possible support and resistance coming from daily moving averages. As we've learned, resistance can cause problems when taking positions with the intent of the stock rising. I like to think of resistance as speed bumps. When you're driving a car in a parking lot and you're about to go over a speed bump, you have to slow down before crossing over, and once you're over, you can speed up again. But if there's another speed bump close ahead, you can't increase your speed by very much before having to slow down again to get over the next speed bump. This is the same concept when trading. If there are many speed bumps ahead, it's going to be hard for the stock price to continue up without slowing down or even getting held back altogether. But if there were no speed bumps ahead, the stock could rev up and have room to take off. Same concept if the stock was dropping down. If there was lots of support underneath the current stock price, then it would be really hard for the stock to continue down. But if there was no support underneath, the stock could quickly fall without any problems. So here's a stock's daily chart that I would not consider buying with the intent of the stock price going up because there are too many speed bumps above the current price. We have the 50 moving average at 796. We have resistance at 813. The 100 and the 200 day are around 850 and resistance at 870. Now, if this stock were to get above 870, I may be interested because the only resistance we have above that is $9.41 and $10. If we were to break $10, then it's off to the races. So I may set an alarm around 870 to let me know, hey, we're coming into an area where there's not going to be resistance for several cents above. So when I'm creating my watch list before the market opens, or if a stock pops up on my scanners and I see a daily chart that looks like this, I just simply ignore it and move on to the next. I want to see little to no overhead resistance when I plan on buying a stock. So here are some simple support and resistance tips. Buy near support. Buying at support will give you the highest probability for a successful trade while also reducing your risk. You can reduce your risk by placing your stops right where the trade does not make sense anymore, and that will usually fall right below support. So if the stock falls below support, it will most likely continue to fall. So there's not going to be any sense on holding on to the stock, watching the stock price fall. You want to put your stop before that happens, and placing them right below support levels is going to be the best way. By placing your stops right below support and you're buying right above support, your stops are going to be very tight, but the reward potential could be very large. Watch for moving averages on both the intraday and daily charts to act as support and resistance. Remember, the daily chart is the most important chart. Those are where we're going to find all of our support and resistance. And where does support and resistance come from? Swing highs, swing lows, and moving averages. We only use the 1 minute and 5 minute to really get in detail what the price is doing around those levels. Okay, so your brain is probably on information overload, and you may be thinking, wow, this is way too complicated, but I assure you, this will be easy stuff the more you practice and the more time you spend looking at charts. It's eventually going to become second nature, where you can just look at a chart for a few seconds and already pick out all the support and resistance levels. I know this is a long video, so please watch it as many times as you need so you can fully understand this really important topic. As always, I hope this has been informative, and I'd like to thank you for watching.